All right, this is the industrial sector that we're looking at right now, looking to replace or add rather an industrial name to our portfolio. The Alpha Up portfolio, which is the one that we are following currently, is a 50-50 score based on Alpha and Up. Alpha is how these companies perform relative to the market when the market is doing well. Okay. And so this is also based on the last 3 years worth of data, not including the current year. And the reason for this is to get historical data and not have it be affected by current, what may be a fad or a temporary, um, um, a temporary event, right? So this is 3 years historic data, and so Fastenal is that company for that particular portfolio. The up score is based on volume. So whenever there are lots of sales or purchases for this company tends to move up. Okay. And a lot of times, this is because these companies are part of larger portfolios through investment banks, mutual funds, and pension funds, and things of that nature. Typically, those particular funds purchase these shares and then hold them. They don't buy and sell, buy and sell. These are typically hold, which means that the price will not fluctuate very much up or down. But it also means that there won't be lots of selling. So the price tends to move up versus down. When you think about a 401k, typically money is going into the 401k and then being allocated to all the companies within that 401k, and those result in purchases. Same thing with mutual funds. So a lot of times these companies, like I said, are part of those larger portfolios. And so Fastenal, again, 50-50 score is both alpha and the up. You can see the alpha there is in the top 63% of all the companies in our basket of stocks. You can kind of see throughout 0.94 is towards the top. And then at the bottom of the portfolio, see 31%, which is towards the bottom. Fastenal being the top. Also, it's important to note, I said this before, that the portfolios allocate money towards the companies with the highest score. And so we see the healthcare, technology, and real estate is towards the bottom. So less money is allocated to those sectors, where energy is typically at the top of all the better performing portfolios. And so industrials, I don't know, it's kind of here and there. Let's take a quick look and see what's going on. So this is the last 12 months. And so the industrials are going to be in the dark blue. And you can see most of the dark blue are here towards the front. There's a few in the back, but mostly in the front. So we want to make sure that we allocate the majority of our funds towards these sectors. So energy being the top, and then second is industrial. So our Alpha Up portfolio is basically right. It's congruent with, again, the best performing sectors for our basket of stocks. All right, Fastenal is the sector leading MVP, meaning that it shows up 5 times out of the last 12 months in the best performing portfolio, followed by TRN and then RHI. Also, we look at the average performance per month. Again, this is going back the last 12 months. And so we can see that HNI is the leading sector performer at 5% per month, which is a huge number, much larger than I think we've seen in any of the sectors, followed by TRN and then Fastenal. Everything else is negative outside of KFY here. So let's take a look at these three companies. I pulled out Fastenal, TRN, and HNI. Now, TRN is really interesting. This is a new company for our basket of stocks. and they are in the railroad business. Typically, railroads do well when there are a lot of when the consumer economy is doing well, right? Because they're shipping products throughout the country, which is how most products are moved in the U.S. is via rail. So again, when there's a lot of purchasing of goods and stuff like that in the country, typically it means the consumer is doing good. Then rail cars will be packed to the brim, and typically they will have better um, profit. Rail cars, I believe, run on diesel. There may be some exceptions to that, but I believe that is really like their biggest expenditure, which is fuel, and then maybe material. So typically steel, right, to actually make the rail cars. There is a component in there for maintenance, right? So we're talking about actual parts for the train cars and the rails. And so whenever materials are more expensive, that's going to also hurt these companies. H&I again is another new company in our basket of stocks, and these guys primarily sell um, furniture to large commercial businesses. So we're talking about storage, we're talking about tables, we're talking about desks, all the things that you need to create an office. And so again, this is typically when big business is doing well, they will typically spend more money on office supplies. And when companies aren't doing so well, one of the first things that they'll pull back on is, purchasing new furniture. Fastenal, the company that has been in our basket of stocks for a long time, and we've invested in Fastenal in the past. They primarily deal with, bolts, nails, nuts, screws, and all the things that's needed to build things. Um, Fastenal did really well for us back in 2020 when there were lots of new things needed during the COVID thing, right? Where companies had to section off certain areas of the office. There were lots of gloves, masks, and things of that nature that was needed. And so we made some decent profit on Fastenal. We got some dividends, and so now we're looking at possibly getting back into Fastenal. Take a quick look at just the surface level numbers here. We see the dividends aren't super high. Matter of fact, H&I has fallen just below 2%, but when you round it up, it's still investable for us because it's close to 2%, right? TRN is the largest dividend, but also the current price is a lot cheaper as well. We can see this is the July 2023 price versus the current price today. And all three of these companies have done really well. It looks like H&I has done the best, which is exactly what we've seen in the 12-month performance. It was roughly 5% to 6% a month. Looking at the PE, TRN is the cheapest of these three, which again makes a lot of sense based on the current dividend and the current price. H&I has the highest PE, meaning it's the most expensive stock compared to its earnings, which again makes perfect sense because it's been performing really well. Now, you can have a PE that gets too high because at some point, stock price will have to fall. It can't keep going up forever, though there may be some exceptions, especially in the short term. All right, the difference in BE. We see that these two guys, H&I and TRN, are actually a little lower than their average PE, and Fastenal is a bit above. And so what this means is relatively that Fastenal is actually increasing its PE. So it's doing better. The stock price is moving up, or earnings may be coming down. Net profit really won't make a huge difference here because these are two completely different companies. You can argue that H&I and Fastenal are somewhat in the same industry, but not really. But Fastenal, better net profit, return on assets, sort of the same thing here. Um, can't really compare these, but again, Fastenal beats those guys out. Cash per share is something we've talked about before concerning the management score. Typically, the more cash you have on hand, the safer the company. This is a big number for Trinity. As you can see, $3.57 of the share price is literal cash. So there isn't a lot of downside risk because cash is cash, right? So basically, this means that the stock price cannot go any lower than $3.57, and the current stock price is only $30. But when you look at the cash to debt ratio, you can see that Fastenal has, even though it has less cash on hand, it has much less debt. And so that's a good thing because, again, if you have $100 of cash, but you owe $100 in loans, then that means you don't really have $100 cash. And so Fastenal beats those guys out. Again, industry makes a difference. And so it's really hard to compare. But so far, Fastenal, I believe, is going to have the larger management score, which is what we'd like to see. All right, alpha. We've already talked about this. Trinity has a negative alpha, whereas Fastenal and H&I has a positive alpha, and they're about equal. The up move, same thing. It's like H&I has a horrible up move. And what that means to me is that when there's a lot of buying and selling, it is possible that it's going to be people selling this thing because it maybe has the price has risen so far. That's very possible. Can't say 100% for sure, but that's kind of what this number entails. Fastenal, the highest up move, again, probably because Fastenal is a really large company, it's probably being held in a lot of mutual funds, investment banks, and things of that nature. And so typically, those investment firms, mutual funds, are consistently buying shares of Fastenal, which does increase the price. Which is why maybe the PE ratio has slowly increased, and the one for H&I has decreased. All right, the down move, same thing, just inverse, right? So when there's a lot of buying and selling, these companies the price tends to move down less. And so Trinity is the best here. I think that has something to do with the fact that railways are really a defensive position because, again, there's not a lot that affects the railroads other than maybe companies aren't shipping as many products. But for the most part, things like tissue paper and socks and soap and all the things that's needed for daily life in the U.S. are going to continually be produced and continually be purchased. And so they have to move by rail. All right, the beta, these are companies that perform better when the market is performing poorly. This is on a month-to-month basis, right? So the way this is calculated is that you take the highest price minus the lowest price, and you get a percentage of the move from month to month. And then you look at how the Dow Industrial Average has changed, highest price, lowest price, and what the difference is there. And so when that difference is a negative, the program then looks to see, okay, how did Trinity perform when the market was down month to month? And as we can see, again, Trinity is a very defensive position. It tends to perform better when the market is not doing so well. And that's because people have to purchase something. They have to diversify their investment portfolios. They want to be in something. And so they will probably tend to purchase Trinity Railway shares when the market isn't doing so well. Whereas you look at H&I, when the market isn't doing so well, people probably tend to sell H&I and move into something else a bit more a bit more defensive. Now, being that the Alpha Up portfolio is the best performing portfolio over the last 12 months or even over the last year and a half, that tells me that the market has done well. And we know that just looking at the Dow, the Nasdaq, and the S&P, we are just shy, I believe, of historical highs in those indices. So as of right now, it appears that H&I is going to, well, actually, yeah, Fastenal, H&I is going to be where you want to be. But that also means that if the market does take a turn for the worse, the company that's going to be affected the most is H&I. The 1 month return, again, this is not current. Okay, this is the last 3 years, not counting this previous year. The 1 month return is actually negative for H&I, but positive for Fastenal. Volatility, Fastenal doesn't move around a lot, and so the higher H&I moves around quite a bit. Trinity moves around even more than that, which is really surprising, honestly. It makes sense that H&I would have a higher volatility, meaning the price is going to move up and down more just because it performs so well. And then people are going to sell those shares to realize a profit and then jump back in when the stock price has fallen some. Fastenal, like I said, not a lot of selling going on. It's probably just a lot of buying for those big investors. And then we can see the management score here. Actually, Trinity has the higher management score, which is shocking. I don't know why that is. I want to go back and take a look. Let's see. So cash to debt, return on assets, net profit. Yeah, I'm not sure why. I want to see what's going on there. 7, 1, 8. That's the cash. Okay. So again, this has everything to do with the cash per share. And again, that does mean something. And then, of course, the actual score based on the alpha up goes to Fastenal, um, which is double that of Trinity. Let's take a quick look now at the performance. All right, so this is Trinity. This is 1 year year to date. This is what, about 9 months, 1 year, then 5 year. So 60, 35, and 20. H&I, huge performer, 60, and then 50. So that 1 year versus that 5 year um, is, I think, a big difference here. Take a look now at Fastenal. Not crazy high for the year to date, 28. But as we can see, 100% over the course of 5 years, which is a huge difference. But more recently, though, 28% versus the 60 versus the 30. I mean, it's what you expect, right? So H&I is performing better than all three of these guys. But when you look over the long term, though, Fastenal has all these guys beat out. And keep in mind, this is a long term investment for us, right? Now we're purchasing these shares, but we have no clue how long we'll hold them. I think over the 10 years we've done this, the longest we've held any one position is probably about 2, maybe 3 years, maybe a bit longer than that if I really go back and do some research. And so it's important that when we purchase new shares, that we don't look for something that's only performing well now, but something that's performed well over the long term. With that being said, it really does look like Fastenal is the better buy. Let's take a look at the financials. All right. So this is the revenue for Trinity. And as we can see, it's really kind of been all over the place. 17, 15, 19, 29, and currently is at 32. So it's definitely going to beat out 2023. But you know, that's current, right? Over the last 3 to 4 years, it's really kind of been all over the place. There isn't a lot of stability when it comes to revenues. If we take a look at, I get back over there. There we go. If we take a look at the net profit now, we see that net income negative in 2020, 180, and then only a third of the profit in 22, and then 106 in 23. Currently, it is definitely going to beat the 2023 number unless something really crazy happens. Take a look at H&I. We'll do Fastenal last. I have a feeling Fastenal is going to beat these guys. So H&I, 19, 21, 23, 24, and 26. It looks really good for revenue growth. Looks like it's steadily increasing. It's what we like to see. And then net income, you see 41, 59, 123, and then a huge drop off here in 2023. We've seen that in some of the other sectors. Not quite sure what happened in 2023 to cause that. But currently it's at 114. So it looks like it's going to be on track to either meet or beat 2022. But again, net income is kind of all over the place. Looking to see what can possibly cause this. Looking at the cost of revenue, this is the money that they spend in order to make their revenue, to get their gross profit. And so as we can see, 12, 14, 15, we'll call this 15, and then 15. So it is steadily increasing with revenue, which is what you want to see. You want to see the cost of revenue decline as a percentage of total revenue. It just means that they're managing their money well. When you look at the gross profit, same thing, the slow increase, and that's good. We want to see. Operating expenses, same thing, slow increase. Not going to dig deep into percentages and things of that nature. Just kind of looking at surface level stuff right now. But we do see that there was a drop off here between 2020 and 2021. But again, it's been a nice increase overall. Same thing here with other income and expenses. It looks like they got some kind of extra money here in 2022. 38 negative, and then back up to 44, and now 38. Not quite sure what's going on there. And taxes, 12, 18, 22, 15, and 23. What this means to me, and again, this all goes to management, right? Because you want to try to keep as much money as you can. And one of the ways you do that is by managing your taxes. And so that means tax strategies and things of that nature. When we look at the income here, the pre-tax income back in 2022, because they had the additional income here, their taxes were 22.5. And here, pre-tax income of 138, which is less than the 146, but the taxes are higher. And so maybe it has something to do with some kind of tax rule change or something like that. But not a great look. And of course, you know, the net income again is kind of all over the place. Take a look at Fastenal now. Revenue 56, 6,000, 69, 73, 74, which is already beating the 2023. So it looks like they're on track to meet or beat unless something crazy happens. And then looking here at the net income, 859, 925, 1086, 11, 1152. So it looks like they're going to meet or beat last year. And so again, that's what we want to see, stability. And that's the reason why the volatility is so low in its name, is because their financials are stable, right? When you want to predict a share price, you want to be able to easily predict where the revenues are going to be. You want to easily be able to predict where the net profit is going to be. And that's what investors are looking at when they go out to figure out, okay, what is this share price going to be a year from now, 2 years from now, right? And so the easier it is to predict the share price, the more confidence you have to invest in that company. And that's why big investment banks, pension funds, mutual funds, and things of that nature that are looking to maximize the performance in their portfolios for their customers are going to turn to a company like Fastenal, right? And so that's kind of what we want to do. It's also a strategy that's been employed over the years, which is follow the big money or follow the smart money, right? So whatever the big investment banks are doing, whatever the big mutual funds like Berkshire Hathaway, Warren Buffett, whatever they're doing, just follow them, right? And so that's kind of what we see here with this, I believe, this upscore, which is we have big smart money coming into these shares. There are reports to look out and see exactly how many shares are being purchased by large institutions to kind of give you an idea of what companies, again, are for lack of a better word, safer to invest in. Because, again, those larger companies are buying shares, typically holding. They're not selling very many of them. But at the same time, you can also look to see if any large institutions are selling these companies as well. Let's take a quick look. I didn't look at this before starting the video, but I am just curious since I'm talking about it. You can see here that, yeah, roughly 85% of large institutions, I'm sorry, 85% of the shares are being held by large institutions. And then we look at Trinity. And it's actually a little bit higher, 87%. And let's look at H&I. 82. So it's a little bit of a drop off. And so what that means is the smaller this number, the more retail investors you have purchasing these shares, meaning that they're going to do a lot of buying and selling, because retail investors, mom and pops, they're not going to hold shares for 5, 10, 20 years. They're going to be buying and selling as they go. Another thing to note here is the number of institutions holding shares. There's only 323 holding shares of H&I, whereas Fastenal, there's almost 1,600, and then for Trinity, 382. So again, even though a larger percentage of shares are being held by institutions for Trinity, there's more institutional investors, more banks, more pension funds, more mutual funds that are invested in Fastenal. And again, that's why I believe the volatility is so low, and it makes it a safer bet. Paired that with the fact that it really does kind of beat these guys out in some of the numbers that matter when you talk about the beta, when you talk about the up move, when you talk about the alpha, right? When you look at the cash ratio to debt, like it's a good company. The numbers are solid. And so, net profit, return on assets, all that stuff makes a difference. Also, again, the difference in PE, I think, makes a difference here as well. Even though the PE is not as high as H&I, because it hasn't performed as well as H&I, it is improving, whereas H&I is somewhat falling off. So with that being said, Fastenal is where we're going. Happy to get back into it. Looking forward to listening to some earnings calls, and hopefully this will be a good position for us going forward. The dividend is tiny, but we can't really complain too much about that. Current price roughly $70, so we won't be able to buy just a huge number of shares, but we may be able to get at least 100 shares because remember we do want to make this one a larger part of our portfolio relative to maybe the health sector and things of that nature. So passing on.